Hello, fools. So, as you know, the pandemic has been a roller coaster ride for retail real estate, but the rebound has been very interesting to watch, something I'm personally quite fascinated by. Today, I'm talking to David Lukes, CEO of Site Centers, and that's ticker SITC. Site Centers owns 80 shopping centers, and they're positioned in wealthy suburbs with strong population growth. So, their kind of thesis is to have a really well curated group of properties. And so David has served as the president and CEO. He's been a member of the Site Center's board of directors since 2017. He's got a large background in real estate and retail. Prior to joining Site Centers, he was the CEO and president of Equity One, served as the president and CEO of the Sears Holding Corporation affiliate Seritage Realty Trust, another one I'm really fascinated by. So I'm really excited to talk to you today. Hi, David.
Hello. Hello. It's good to talk to you.
So I know that all of your properties are open and you've gradually been collecting the rent that was deferred during the pandemic. It sounded like on your most recent earnings call that that's nearly caught up. Is that right?
I would say so. I mean, we had our earnings call yesterday. We reported that we've collected 98% of the second quarter rent. I don't think that surprises anybody because shopping is doing quite well right now. Shopping centers are full. I think what was surprising is that as of last week, we've collected 95% of all of the rent last year in 2020. And I do think that's a pretty shocking statistic. And I think a lot of investors were surprised.
Well, let's talk a little bit about what's happening right now because it's something I'm watching. I'm sure you're watching. We've seen mask mandates change. They're changing both nationally and by certain areas. Are you concerned about another lockdown and its impact on retail?
Well, I'm personally concerned because I'm getting sick of my basement. But I think from the shopping center perspective, if you take retail and those of us that invest in real estate that's retail oriented, there's really two food groups. There's the regional malls where people go for fashion and apparel.
Right.
And then there's the open air shopping centers where people go for, Target and Walmart and grocery stores and, discount apparel and things. That seems to have been pretty insulated from damage during COVID. And I think a big reason is that a lot of these tenants figured out how to distribute goods from their stores. So I'm not as concerned about mask mandates. I mean, we have seen in LA County and now a couple of other parts of the country just in the last couple of days that masks are the new normal. But in terms of a shutdown, I would be concerned that would have an impact on some of our tenant base, particularly movie theaters.
Well, I think one of the things that you do that's really interesting is you've got a lot of essential real estate, which we all learned last year. Essential real estate, essential businesses did really well. So Targets, Walmarts, things like that. One of the things that I'm tracking is dollar stores and how much they're adding space. So you've got a lot of strong national tenants. I know you've got Dick's Sporting Goods, which is doing well. What ones are you seeing expanding most this year and going forward?
Yeah, well, since you brought up the dollar stores, I'm sure, you were, if you have teenage kids or tween kids, I'm sure you've been into Five Below. Five Below has been on a real growth tear for the last 5 years or so.
Yeah.
And I guess in my mind, I would say the Five Below really gears towards the tweens and the teens. But Dollar General is one of the largest, store operators in the United States. And they just started a new concept called Pop Shelf. And I toured the first one that I had seen about a month ago in Atlanta, and they are definitely becoming very aggressive, which I'm excited about because Pop Shelf takes about the same space size as Five Below, but they're geared a little bit more towards the parents. And so it's a great example of a 10,000 square foot store that, 3 or 4 years ago, there were not that many tenants signing leases at that square footage. Now you've got Pop Shelf, Banfield Pet Hospitals, you got Ulta Cosmetics, you've got, a whole litany of sporting goods stores. Dick's Sporting Goods has a new concept called Public Lands, which is really cool. I mean, it's almost like an REI. So there's a lot of tenants that are expanding. And the great thing for us is they're not startups. They're really high credit tenants. Remember when TJ Maxx started these other brands like Home Goods and Home Sense and now Sierra Trading Post. So for a landlord that focuses on credit, it's great when a really high credit investment grade company starts a new brand because the guarantor on the lease is the credit of the parent company.
Yeah, that is a really good point. And that brings up another question I had, which is tenant size in terms of square footage. Are you seeing that change? Are you seeing some of the bigger anchors get smaller?
Well, the trend for the last 10 years was definitely tighten your belt. get a little bit smaller. You heard tenants like Staples and Petco, Office Max. They talked about shrinking their footprint and trying to stay relevant, but not have too much inventory in the stores. And I'm equally as surprised as you probably are that the pandemic, within 90 days, the retailers and the customers figured out that they liked having inventory a mile from their house because they can get it quickly. So what we've been witnessing is a lot of the larger tenants have not been reducing their footprint. In fact, I would say some of them are actually increasing their footprint. And I suspect the reason is they're allocating more space towards back of house sorting and a little bit less space towards the customer.
Yeah, that is something that I've been fascinated by. It's such a big trend because I feel like in the past, your store had one customer, the person who was in there and browsing, and
That's right.
now you've got Instacart and things like that. You've got e-commerce. There's also curbside pickup and BOPUS, which I think is my favorite acronym lately. How does that impact your centers as a whole? Are you finding that you need to have parking layout change or things like that to accommodate retailer demands?
Yeah, it is definitely the most interesting kind of COVID outcome. And honestly, I feel a little bit lucky because, if you think of tenants of ours like Petco and PetSmart, they had over leveraged balance sheets. We were all wondering if pet food sales was going to happen online. And what happened, when Petco went public, they gave a lot of disclosure. And one of the things they said was that their online sales doubled last year, and 83% of those sales is delivered from the store. So from a landlord's perspective, that's really great news because now I have a credit tenant where 83% of their online sales is being shipped or delivered from the store or bought online and picked up in store, BOPUS. And the customer seems to have accepted this. And so it's becoming the new normal, and it's great for us. In terms of changing the footprint, last summer, there were a lot of tenants that said, hey, can we put a roll-up door in along the side? Can we add another loading dock? Can you put some temporary parking stall painting in the front? And we did everything we could to make this work because it's in our best interest. But it seems to be a trend that's continuing.
What are you thinking about supply chain issues? It seems like things haven't resolved. Part of that is COVID. Part of that is things like the Suez Canal stoppage that we had. Do you think that's going to continue? This has lasted a lot longer than I would have predicted.
Yeah, if you try to find patio furniture last summer, you were well aware of the problem. I do think it's going to be, there's so much geopolitical risk right now. I do think the supply chain is going to be trouble for a while. I guess, one of the things that I always like to remind people is that in regional malls where you have a lot of apparel, a lot of the leases between landlord and tenant are more like a partnership where the landlord gets a percentage of the sales that the tenant makes. In the open air shopping center space, it's the opposite. More than 99.5% of our rent is contractual fixed every year for 10 years. So whether they, blow the doors off in sales or whether they struggle, they still have to pay the same rent. So I think that there will be supply chain problems. I don't see it having an impact on our rental stream.
So in other malls that are struggling, one of the things that I've seen is Amazon fulfillment centers coming in. It doesn't look like that's something that's been something you've been pursuing with site centers, but is it something that you're watching as a trend?
Well, with Amazon specifically, no, I would say that it appears to me that they've been using more of the industrial footprint from a real estate perspective. And I think the Amazon competitors, which would be Target, Walmart, the grocery stores, they're using shopping center footprints because they're combining the back of house distribution fulfillment space with the shopper space, and they're using the same inventory for both. So I think that's been a bigger trend. Well, there's been a couple of upstarts that are really only fulfillment. One of them was a SoftBank-backed company called GoPuff. If you have a college kid, you're probably aware of GoPuff. And they've been signing leases with us in the back corner of shopping centers with no visibility at all. And it's simply a micro fulfillment center. So there have been some of those.
Interesting. Yeah, GoPuff is getting bigger very, very quickly.
Yeah.
Well, that also brings up another question I had, which is you mentioned Target and Walmart. They're getting so heavily into grocery. You have a lot of grocery store tenants. What are you seeing for the grocery store of the future? How is it shifting?
Deirdre, that is probably the number one most prescient question in the open air space is what happens to grocery? Because the format for a grocery store, hit 50, 60,000 square feet in the 1960s. And it's virtually stayed there until you had some specialty grocers come in like Trader Joe's and Whole Foods and Aldi and Sprouts and Fresh Market. And they're much smaller boutique grocery stores. So there seems to be a fight that's kind of gearing up, which is if you as a customer, are you going to go to your full line Kroger or Publix or Harris Teeter, or are you going to start to take some of those dollars to, the Sprouts and the Fresh Markets and the Trader Joe's, and who's going to win in the end? And then on top of that, you've got all these ghost shoppers where you're buying online with Instacart, somebody else is doing the shopping and delivering it. For the most part, as a landlord, because our leases are so long, it's not so much of a concern unless customers stop going to the grocery store in mass, and then all of a sudden the shops adjacent to the grocery store don't do so well because they don't have cross shopping. That hasn't happened yet, but that's always kind of an overhang that we've had maybe for the past 5 years.
Interesting. Yeah, it doesn't seem like that has happened. I think a lot of people thought that that was going to happen during the pandemic, that people were going to get very accustomed to shopping for groceries online. But I think there's still that discovery element. Is that sort of what you see driving the desire to go to the grocery store?
Yeah, and I think if you think about walking into a full line grocery store and you walk in and you've got the produce and then you circle around and you hit the meat section and then the dairy, and the frozen foods, those are things that people really do like to go to the store and pick out. I think it's the middle of the store that people are more concerned about. That would be the Procter and Gamble stuff. That would be the canned goods and the dry goods, because those are easier to deliver online and kind of click and get delivered. And I do think that's why some of these grocery stores are replacing the middle with something else, whether that's a wine boutique where it's prepared foods or, a sandwich shop or a coffee shop. So I think that the tenants are starting to adapt their footprint, because really the grocery stores, remember, they have very cheap rent. I mean, a lot of these grocery stores are paying $1 or $2 in rent, and the shop tenant next to them is paying $30 or $40. So they don't want to give up their space. I think their trick is, how do I drive more margin out of the same square footage? Maybe I move the canned goods out and I bring in a coffee shop. And I think that's why you see tenants like Wegmans, which is a fantastic grocery store in the Northeast. Yes. They do so well because they just have a lot of prepared foods and it's fun to go to.
It absolutely is. The news lately was that Wegmans is taking over an old Kmart in Manhattan. And I think that's sort of a very interesting story, that sort of people just love Wegmans because it is experiential.
Yeah. Yeah.
Well, let's talk about lease length and renewals and what you're seeing. Are you experimenting with shorter leases or pop-ups? I know we've seen some other mall centers trying that sort of thing. Doesn't seem like that might be something you would need to do because you do have those open air shopping centers.
Yeah, we do have what we call an ancillary income department, which is a group of salespeople that work on kiosks and temporary Halloween stores and fireworks stands, things that you can add here and there throughout the year. Whenever you hit a recession, the ancillary income team becomes very important because they have to temporarily fill vacancies while you're waiting for full line long-term tenants to arrive. The irony in this recession is that the tenant demand got so hot starting in September that we just don't have space for temporary tenants. I mean, our leasing volumes right now are 30% higher than they were in 18 and 19, which were really high volumes. So the demand for space is so high. We're not experimenting with shorter lease terms because we're getting national credit tenants and we want it for 10 years. So the lease terms are really staying 10 years for boxes and 5 years for shops. And I haven't really seen that change.
Can you explain just quickly the difference between boxes and shops?
Yeah, everyone defines it differently. For me, I say if it's greater than 10,000 square feet, it's a box. If it's smaller than 10,000 square feet, it's a shop.
Fair enough. Thank you. So you mentioned the national tenants. What are you seeing on the local level? One of the things I'm tracking as a trend is medtail, medical offices inside malls. Is that something that's happening for you on a local level?
Yeah, you're seeing. I honestly think that this kind of refound love of the suburbs, and particularly this work from home flexibility, that I do think is going to stick in some way, shape, or form. What it means is, if a couple was around their shopping center 2 days a week and then 5 days a week they were in the city, now if they're near their shopping center 2 more days a week, all of a sudden it's a 100% increase. And a lot of service tenants have figured this out. So we're seeing, the Aspen Dentals and the cryotherapies and the Massage Envies and, those types of personal services, the nail salons, the salon suites, very active because they know that their customer probably won't go to the dentist in the city anymore. They're just going to go to the dentist in the suburbs because they're going to work from home for another day or two. So those have been very popular. Other tenants that I find fascinating is kind of the whole food and foodie culture. Now we've got tenants like Sweet Green, which I'm sure you've been to, and they're expected to IPO this year, and they've just been going gangbusters. So they're fun to try and get the latest retail food concepts into your properties because it does draw traffic.
Well, I heard you on another call saying that for your properties, fine dining is Five Guys. So in
Yeah.
terms of restaurant, what are you seeing? Are you seeing those smaller restaurants kind of still thrive, especially if they offer takeout?
Well, that is definitely a complicated subject, and this is just my opinion based on what I'm seeing. I think what really happened is the local restaurants, the local pizza guy, the kind of local ethnic restaurant, they really struggled in COVID. In many cases, they closed. And so, what happens when this pandemic emerges and then leaves, and all of a sudden tenants are signing leases? It's the national chains that have, number one, access to capital, right? Big public companies like Chipotle is really signing a lot of leases. Sweet Green going to go public. You got Portillo's out of Chicago, I think might go public. We've got Mission Barbecue has been signing some leases. They're the bigger companies because they have access to capital, but more importantly, they have access to people. And that seems to be the biggest emerging trouble with restaurants is the local restaurants that don't have good benefits, good pay scale, 401k plans, that they can't get the workers because the workers are just simply going to the better companies, which tend to be these large national chains.
Let's dive into that because I think the staffing concerns thing is something that we've been covering a lot on Millionacres and at the Motley Fool. It's big for restaurants, big for retail. We're heading toward the holiday season, Black Friday. Everybody's getting a little bit worried about that. Is that something that you're concerned about?
Yeah. I mean, look at the three largest expense for a retailer: inventory, staff, and rent. And I mean, those are the big three. So if inventory, because of the supply chain, they might have to pay more for inventory. They might have to raise the prices. Rents are going up because in suburban shopping centers, particularly in wealthy zip codes, it's just hard to find space. And so what's left is your staff, and the staff right now are really tough to find. So I do think the companies like TJ Maxx and Ross and Burlington and Target and Walmart, they can hire and they can pay well and they can retain talent. But when you get down to the local shops and local restaurants, I do think it's a lot more difficult.
Yeah, that is a really good point. On your earnings call, you talked a little bit about acquisitions. You're generally looking in, trying to be really selective. You made a really good point about smaller properties and more secure rent rolls. What are you looking for right now when it comes to acquisitions?
Well, one of the biggest changes for my career is and I kind of joke about this, but when I first started in real estate, we would have to hire hourly people to write down license plate numbers in the parking lot. And then you would go to the DMV and you would ask them to give you the zip code of that license plate. And then you would make a hand-drawn map to figure out where your customers coming from. Now everybody carries a cell phone and we can buy cell phone data that tells us who's coming to the shopping center, how often, what time of day, and how many times a week. We do know that 80% of the US population goes to an open air shopping center once a week. 20% goes
Wow.
10 times a week. So the whole trick with acquisitions is you need a very high trafficked corridor because you want to have, the salmon swimming up and down the stream. You want that opportunity. But the most important thing to check then is what's your capture rate? How many of those people are pulling in, stopping at the center and shopping? And that depends on what you're offering them. And that's why I would love to replace a local restaurant with a Sweet Green, because you're getting more capture rate. And the more times you do that, the better. So in acquisitions, we look, number one, at traffic count. Number two is the trade area that we're drawing from. What's our capture rate? And number three is the credit worthiness of the tenants and how they're performing.
Well, that brings up something that I've thought a lot about, which is curation of malls. I feel like the pandemic has sort of kind of woken up some of the mall operators and realizing that having the same chains in the same places is good, but you also have to have an interesting mix to get that 10 times a week that you're talking about. How do you think about curation when you're signing leases?
Well, the challenge, I mean, if I say much, good news is you have great credit for long-term leases. The bad news is it's long-term leases. So if you have a tenant from the 1990s, it's become completely irrelevant for the next generation. Too bad, they're in your center for the next 20 years. And so you almost have to wait for a bankruptcy for the opportunity to replace that tenant. And it does happen. I mean, remember we lost Circuit City and Linens and things and, those types of old line tenants. And now we can replace those with someone that's more relevant. Babies R Us, Toys R Us was a big liquidation that left with us a lot of inventory. But the good news is we can put in great tenants. We can put in grocery stores and Trader Joe's and Whole Foods. So curation is more like a once in a decade opportunity. And it's very, very important as an operator to pick the right credit, but also pick the tenants that really resonate with the customers.
Are you seeing some of the direct to consumer brands start to take space in your centers?
Very minimal, very minimal. It feels like some of the direct to consumer brands like Warby Parker They first went to the fashion malls. So we just haven't seen many, actual brands decide that they're going to go into open air strips. What's been more popular is the mall tenants deciding, I don't need to pay 4 times the rent to fashion mall when my customer goes to Whole Foods 4 times a week. So you've got some of these tenants like Bath and Body Works or Sephora or Nike or Adidas or Lululemon, very, very popular during the pandemic, great sales volume. And they're looking at the mobile phone data and saying, well, geez, if Deirdre is going to the mall once a month to go to Lululemon, but she goes to Whole Foods 2 or 3 times a week, why don't we just move across the street, pay less rent, sign a long-term lease, and all the profits go to us as opposed to sharing with the landlord? That's definitely a trend that's starting to emerge.
Yeah, I've watched that too. I know Victoria's Secret is one of the ones that is pursuing the off mall strategy, and it makes a lot of sense for those reasons that you mentioned. Wanted to learn a little bit about your joint venture partners and what you're doing with joint ventures.
Well, originally, as you know, when the REITs went public, it was a way to access public capital. And then there was a period of time in the 90s where several landlords, including our company, started doing institutional joint ventures. And it's really a way to leverage your own capital with someone else's that has a similar long-term view. It's usually pension funds and insurance companies or sovereign wealth, right? It's long-term capital. And matching long-term capital with a public company is a good match. What we would not really want to do is be, in joint ventures with short-term hedge funds or short-term private equity funds. But the long-term capital is really great. Our joint venture pipeline has shrunk in the last few years. We closed down a longstanding JV with Teach, closed down a longstanding JV Black. It's always because it usually allows advantage what your partner does. So it's a way to access inventory in downturns when it's hard for me to issue equity. The other nice thing is at the tail end of the joint venture, it's inventory that you've raised them, you've leased it for 10 years. And so if the joint venture wants to liquidate, you have a chance to buy some of those properties before they go to market.
Would you ever do what some other brands have done, mall operators taking a share in a business, like a tenant?
We really kind of part of our business. I would say that's been marginally successful. There's some really great cases where landlords have made a lot of money taking a position in a retailer. I think from our perspective, our stock trades on simplicity and durability. And so I'm very careful to be a good steward of shareholder capital and get the best return I can. But remember that risk is really important. So we've generally stayed, almost exclusively on being just a landlord, plain and simple, and we haven't really played too much in that other category.
Interesting. So what are you thinking about some of the larger trends in culture in general? So we've got remote work. It sounds like you think that that's going to continue. What are you thinking about things like autonomous cars, things like that? Are there things, when you take that sort of 5-year, 10-year, 15-year, 20-year view, what trends are exciting to you?
Well, the work from home one, admittedly, you have to take my comments with a grain of salt because it would be beneficial to me if we had a long-term work from home, since most of our real estate's in the suburbs. But I do feel like that's sticking. I mean, I have to tell you, I've not met very many people that want to go back to an office 5 days a week. And I think companies figured out that it works just fine. I mean, we're a $6 billion enterprise. We've been remote for 18 months. So I do feel like that's a long-term trend, and that's the one I'm most excited about. If you think kind of even longer term trends, the self-driving automation in cars, I think is really interesting. We did a pilot program with Google's self-driving car unit called Waymo. Mm-hmm. We have a property in Ahwatukee, which is a kind of the southern suburb of Phoenix. It's the number one traffic intersection in the state of Arizona, and our property is right on the intersection. So Waymo wanted to test their self-driving car platform. They started signing up customers in the area. They started figuring out, can we give you free rides to the movie theater, and what happens to alcohol sales when nobody has to drive? I mean, they're testing all of these things. I do think that self-driving cars might be the next biggest thing for open air centers, because the ease of moving back and forth, the ease of delivering in the last mile, the ease of fulfillment, that stuff becomes a lot better if traffic goes down, and it becomes a lot easier.
Oh, that's really fascinating. So how long was that trial with Waymo?
It started in 2017. It's been for a couple of years now. And I mean, and riding in one of them is hilarious because it's the strangest feeling. They have an actual person that's sitting there just in case. But the car drives itself. And what you're seeing is people are using it, like I've got 3 teenagers. So it would be if they want to go to the movie, and it's kind of like an Uber, but it's a service that you use. So I do think it could be a part of our culture going forward. I mean, looking out 10 years, I don't see why not.
In terms of marketing site centers, do you market to the consumers themselves, or are you mostly marketing to tenants?
Tenants, yeah, it's exclusively tenants. I mean, we've thought about branding ourselves. There are some mall operators, particularly Simon, which does a great job branding their malls, Simon Malls. I think the difference is that when you're talking about fashion and luxury goods, the brand does kind of resonate. When you're a customer at a convenience property, you're going there for a purpose, which is usually, grocery, or it's food, or it's a nail salon, or it's a pharmacy. I'm not sure that the landlord really has a lot to do with the brand of that property. So we really focus on helping our tenants get their brand out there more than anything else.
Excellent. Last question for you. Where do you see site centers going in the future? Is there any other thing that you kind of have your eye on in terms of the business?
Well, I think slow and steady is going to win the race in the REIT world. I mean, you really have to do the best you can to grow steadily every quarter without taking too much risk. I am very, very intrigued by some of these anchorless properties that we've been buying because, in the olden days, you had to buy a property that had an anchor because you had to rely on them for the traffic.
Right.
If a grocery store was doing $800 a square foot, that must be good. Therefore, let's buy that property because the shops must do well. Now, with all of this consumer data and mobile phone data, you don't really have to rely on the anchor. You might want to buy the anchor because it's TJ Maxx credit, but you don't have to rely on it. You can rely on this customer data. And I do think it's a subset of our shopping center world that's very, very intriguing because you can get much better prices. You get better leases with the smaller shop tenants, and you probably get a lot more rent growth if we get a little bit of inflation.
That's fantastic. It really seems like so much of what you're doing is going to be driven by that cell phone data going forward.
Yeah, I think so. I mean, it has had a big impact. We started using it when we were pitching to tenants. You would go to Sweet Green, who was a young restaurant tenant, and we'd say, "Who's your customer?" They'd say, "Oh, it's a working couple that's between 25 and 36." And we'd say, "Okay, in 10 minutes, I'm going to show you how many of those customers come to your properties. What else do you want to know?" "Well, we really go for college educated customers. That's who shops at us." "Okay, well, this is the percentage that came here that have a college degree." You can get an incredible amount of data. You can map it. You can show it to the tenant. And so it helps you with leasing. Now we're starting to use it on the acquisition side because now we have capital that we can deploy. So we're starting to use that to buy.
That's fantastic. Well, thank you so much for your time today, David. This was really a fascinating deep dive into retail real estate.
Thank you. I appreciate your time very much. Thank you.